Hey traders, Ragi here, and in tonight's video I'm going to walk you through some trade management. I'm going to walk you through how I take an entry and manage it well past, say, a first or second profit target and the tools I use to do it. So a lot of times our focus is on the market trends and the strategy that we'll use to enter a trade. And that's obviously a big part of what we do, keep our pipeline full of new opportunities. But I think a lot of times we're so interested in looking for that next new opportunity, we're not getting the most out of our current open trades. And that's what tonight's video is about. So I'm using the MT4 platform here, and this is one of 3 different platforms I use. I've got a account here with MT4. This is actually an FXCM account. I have a TradeStation account, and I also have been using a little bit of Thinkorswim. And I do recommend for traders, especially in the US, to have more than one Forex trading account. And mainly, I've done this for years. I've separated an intraday day trading type account where I'll focus on 5, 15, and 30-minute entries, and I'll separate my longer term daily chart trading account in a completely separate account. So that could be a topic for a video sometime in the future. But what I want to focus on here is trade management. And so we have a number of open trades right now, and I can take you over to our Forex spreadsheet. In this green section here are our open trades. So this is something that I make available to members so they can see not only the trades that are pending, the trades that are open, when they were opened, the strategy, aggressive entry levels, conservative entry levels, as well as all the risk management. But what we're focusing in on are the 2 columns I call the first PT and second PT. These are the first and second profit targets. And certainly the first profit target, as maybe you've heard me speak of before, is very important. For this Euro US, we have a very recent entry on the spreadsheet from 1445, 1.1445, and we took this trade down through 1280. Now 1280 is important because it was the first profit target. And upon hitting that first profit target, we move away from the point of validity stop loss, what I would consider the risk-based stop loss, and we go to a break even. Now this is huge because I have a number of trades that are still open in not only the Euro US but the Euro Pound. And I show you this because the way I'm able to manage some of these now large winners, my Euro US, some of my older Euro US positions are crossing through the 900 and 1000 pip winner mode. And this isn't going to be with the full complement of lots that I had when I first started and opened the trade, but rather as I scale out of the trade, once I get past the second profit target, what I want to do is use what I call an EPMR, an expected price movement range, along with the daily price movement range, so that I can manage a trade into, let me just show you the EPMR and daily PMR on the Euro US, so I can manage a trade into what would be then now a trailing stop, what I consider more of a safety net type analogy mode, where I'm just backing off and letting the pair just do its thing. In other words, I'm not going to presume I know how high is and how low is. I'm going to let a trend continue, because this idea that I know ultimately where a trend is going to go is really a very not only false but damaging. A lot of traders think, oh, the trade went 200, 300 pips in my favor. Let me reel it in and get out. But in reality, they could be leaving hundreds of pips on the table. So never cap your trade. Back off, but do it strategically with information like this. And I like to actually overlay it right on top of my chart. So let me walk you through just a few of these. Here's the Euro US. And if I was going to trail a stop, currently the trailing stop on the spreadsheet is at 10.55, and I don't want to get any closer than 109.25 or 109.55. This expected price movement range gives me the absolute closest level that I would be willing to trail my stop down to. Here's the Euro Pound, another one of my older positions. And again, I have a trailing stop at 73.05. But when the EPMR comes up, I'm going to notice that if I want it to be a little closer than 73.05, I could be down near 72.10, maybe 72.25. And again, understand that by using this data, I'm not smothering the trade. I like to be above the previous candle high in a downtrend, or I like to back off by perhaps 2 daily PMRs, meaning in the euro pound, I want to back off by perhaps really be no closer than 100 pips, and maybe even consider about 130 pips as far as a cushion to let this market continue on without my smothering it. So notice here I could go as close as 72, say 10, 72.25, but I could also keep in the back of my mind that 100 to 130 pip level. So you can notice here from 71.73, I tack on 130 pips, and that's going to put me even above this level. So you get to decide, based upon your tolerance, how close you want to get and how much house money you want to risk. Now for me, I usually like to back off by about 2 daily PMR. That's about the closest I typically like to get. But if I really want to ratchet in on the trade, I could start using these EPMRs. So here's another example, and the dollar Canada is getting pretty interesting for me right now. The dollar Canada, where I'm in from 24.55, and I've already crossed the, as you can see here, we've crossed over not only the 25.65 level, but I'm waiting on whether or not we can actually start getting up even higher through 26.80. That's my second profit target, actually. Or actually my first non-negotiable, but it would be the second level at which I'm taking a profit, since I've already taken 25.65 off the table. Once I do that, I can say to myself, well, as of right now, I've got 180 pips that I can play with. What does that mean? I have 180 pips that I can risk without actually risking my capital. So the question is, how much do I have that I can give back of unrealized profit, or what I call house money? Well, if I have a cushion of about 180 pips, almost 200 pips, and my average daily pip movement range times 2 would put me at 160 pips, I can back off by 2 daily PMR. I'm not quite at the high level yet. That would be closer to about 240 pips, but I could back off as a trailing stop of about 160 pips. I'd rather do that once I cross the 26.80 threshold, and then I could start thinking about, hey, I've got it to risk. It's pure house money. My capital is nowhere near at being at risk, and I could back off by about 160 pips. And I'd like to do that once I get through 26.80. So I hope you're getting an idea of how I do this and how effective it is in keeping me out of kind of that smothering range where a lot of you probably experience. I have too, before I understood these price movement ranges, where the market comes back, tags your stop, gets you flat, and then continues on in the direction of the trend. And this is the last thought I want to leave you with today's video. This works best when I have a strong trending market. I'm not going to want to be that generous on backing off by these EPMRs and DPMRs unless I have the flow of the river, the strength of the trend behind me. So this is definitely a trend trading type trade management strategy. And I hope you've got a better idea on how I do this and how I'm able to capture some of these deep triple digit, even getting into 1,000 pip winners, not with my entire trade, but with a good part of my overall position, because I've now just transitioned into risking nothing but house money. That's a very important concept. How do you take your capital off the table in terms of risk after hitting a first and second profit target and then backing off? So I hope this was a lesson, or at least got you thinking about how you're managing your open trades, especially when they become monster trend trades, big winners, and how do you make sure that you're not scaling out so aggressively that you're left with nothing when a trade could go 300, 400, 500, 600 pips and much, much more in your favor.